Click the bell icon to get latest videos from Ekeeda.
Hello friends, let us discuss various important concepts relating to retirement of partner. When in existing partnership firm, one of the partner retires, we are required to consider certain concepts. Those we are going to discuss now. Let us start now. First is gain ratio or benefit ratio. Before retirement, if there are three partners, profit is shared between three. When one of the partner retires, in future, continuing partners will be sharing the profits. Obviously, this results in increase in share of profit of continuing partners as one of the partners' share is reduced. The amount of gain which continuing partners get, we can calculate as new share minus their old share. Obviously, new share will be more and old share will be less. Difference is called as gain share. When we calculate ratio of this gain, it is called as gain ratio. After the retirement of one partner, remaining partners are expected to get more share of profit as a part of retiring partners' profit will be distributed to remaining partners in future. This extra profit to be added to remaining partners' share, such portion of profit has been called as gain. All such gains or profit need to be distributed to continuing partners in gain ratio. It is normally used to write off goodwill created or raised to the extent of retiring partner's share only. It is calculated as follows. Gain ratio is equal to new ratio minus old ratio. Treatment of goodwill. When partner is retired, we are required to return his capital and shares in accumulated profits or loss, share in revaluation profit and loss. Along with that, we are required to consider his share of goodwill in existing partnership firm. Goodwill, it is a reputation of partnership firm valued in terms of money. The goodwill is shown, valued, raised, adjusted in books at the time of retirement of partner in following different ways as agreed between the partners. If goodwill is raised to its full value and retained in the business, that means all partners, including retiring partner, they agree with some value of goodwill, say 30,000. This value is recorded in books of account that we call as goodwill account open or goodwill is raised. Goodwill account debit to all partners capital account in old ratio. Being full value of goodwill is distributed to all the partners in old profit sharing ratio. In this case, goodwill appears in new balance sheet at full value. Next alternative is if goodwill is raised, fully raised, and then written off. Here we are raising the goodwill and then we are writing off. That means goodwill will not appear in new balance sheet. When we raise goodwill, we'll have the same entry, first entry as we have discussed here. For second entry, that is for writing off, our entry will be continuing partners capital account debit to goodwill account. Goodwill account debit to all partners capital account. This is for goodwill raised. Continuing partners capital account debit to goodwill account. This is for writing off goodwill. This has to be done in new ratio. In this case, goodwill does not appear in new balance sheet. If goodwill is raised to the extent of retiring partner's share only and retained in business, here we are not going to raise goodwill at such full value, but we are going to find out only the value of retiring partner's share in goodwill. Goodwill account debit to retiring partner's capital account. Being share of goodwill of retiring partner is credited to his capital account. If goodwill is raised equal to retiring partner's share earlier, now a written off. That is, goodwill raised and written off to the extent of retiring partner's share. For goodwill raised, our entry is goodwill account debit to retiring partner's capital account. For writing off, continuing partner's capital account debit to goodwill account. This is required to be written off in gain ratio as discussed earlier. Else we can have entry without opening goodwill account, continuing partner's capital account debit to retiring partner's capital account. In this case, we are not opening goodwill account. Goodwill account is not opened, but continuing partners capital are debited and retiring partners capital is credited to give him benefit of goodwill. In this case, goodwill does not appear in new balance sheet. If goodwill is given in old balance sheet, the net result of its revaluation may be shown either in profit and loss adjustment account or shown in partner's capital account. At the time of retirement of partner, suppose goodwill exists at 30,000 in balance sheet. Adjustment says goodwill is raised by 10,000. So 30,000 plus 10,000. So this 10,000 increase in amount of goodwill can be considered as revaluation of like any other asset, and it will be credited to profit and loss adjustment account. Alternatively, it can be credited to partners capital account. Adjustment of reserves accumulated and profit and losses. Any reserve fund, accumulated profits appearing in liability side of balance sheet may be credited to all partners in their profit sharing ratio, or only the share of retiring partner is to be credited to his capital account, depend on partner's agreement or the instruction given in the problem. In such case, only retiring partner's share of general reserve profit is credited to his capital account, and share of continuing partners is kept in balance sheet and it is not distributed. All the reserves profits which are distributed will be debited. General reserve account debit, reserve fund account debit, profit and loss account debit to all partners capital account. Being accumulated profits credited to all partners capital account. Any accumulated loss appearing on asset side in balance sheet should be debited to all partners in old profit sharing ratio at the time of retirement. If existing balance sheet shows on asset side some accumulated losses like debit balance of profit and loss account, preliminary expenses, or not written off miscellaneous expenditures, then those will be written off among all partners. Capital account will be debited. All partners capital account debit to profit and loss account. Being accumulated loss debited to all partners capital account. Revaluation of assets and reassessment of liabilities. At the time of retirement of partner, all assets and liabilities will be revalued so that any benefit or loss on revaluation can be adjusted against all partners' capital account in profit sharing ratio. The retiring partner is entitled to get proper share in increase in value of assets or decrease in value of liabilities. He is also liable to share any decrease in value of asset and increase in value of liabilities. To give the effect of the same, revaluation account is prepared. It is also called as profit and loss adjustment account. Decrease in value of asset or increase in value of liability are shown on debit side of this account, but increase in value of asset, decrease in value of liability is shown on credit side of this account. Adjustment of capital. After revaluation of assets and liabilities, revaluation profit or loss is divided in profit sharing ratio and transferred to partner's capital account. In case of profit, it will be transferred to the credit of partner's capital account. In case of loss, it is transferred to the debit of partner's capital account. Adjustment of capital. The remaining partners, continuing partners may decide to keep their capital contribution in their profit sharing ratio. The total capital of new firm may be decided or agreed by continuing partner as below. The total capital of the firm is divided in new profit sharing ratio. New capitals are then compared with latest capital, that is closing balance on partner's capital account after adjustment of all retiring partner related items. Latest capital balances in capital account. Surplus or deficit in individual capital account is worked out. Such surplus or deficit can be withdrawn or brought in cash or transferred to current account as per the partner's agreement or decision. Such difference may also be transferred to partner's loan account. Accounting entries. For surplus cash paid to partners, partner's capital account debit to cash bank account. For deficit cash brought in by the partners, cash bank account debit to continuing partners capital account. Surplus transfer to current account. Partners capital account debit to partners current account. Deficit transfer to current account. Partners current account debit to partners capital account. Ascertainment of retiring partner's share of profit till retirement. If partner retires on any day other than the date of closing of account, is entitled to his share of profit or loss till the date of his retirement. Such share is calculated as follows. Profit is calculated on the basis of profit of last year or average profit of last 2 or 3 years. Find out the profit for the period, that is profit till the date of his retirement. Calculate retiring partner's share out of that calculated profit and record the same as follows. Suppose balance sheet is given as on 31st March 2019. Partner is retired say on 30th June 2019. That means 3 months during current financial year he has been continuing in business as partner. So on retirement, even though financial year is not over, we are required to estimate profit for that 3 months. Such estimation will be done on previous year's profit or last 2 or 3 years profits average. We'll get that such estimated profit for full year, and proportionate profit will be calculated for 3 months, and accordingly retiring partner's share in such estimated profit is calculated and credited to his capital account. Profit and loss suspense account debit to retiring partner's capital account. Retiring partner's capital account credit side it will be recorded, and that suspense account will be recorded in balance sheet on asset side. Amount due to retiring partner's final payment. The amount due to retiring partner can be paid off as per the terms of partnership agreement or otherwise mutually agreed upon. Following are various types of repayments of retiring partner's dues. Lump sum payment. Total amount payable to retiring partner is paid at a time. The entry will be as under. Retiring partner's capital account debit to cash bank. Installment. If the amount payable is large enough, then payment is made in installment. For transfer of capital due to loan account, retiring partner's capital account debit to retiring partner's loan account. For charging interest on such amount payable, the entry will be interest account debit to retiring partner's loan account, being interest charge or interest payable. For payment of installment, retiring partner's loan account debit to bank. If total amount due is transferred to loan account, then entry is retiring partner's capital account debit to retiring partner's loan account. Out of amount due, partly paid in cash and balance transferred to loan account, combined entry will be retiring partner's capital account debit to cash bank to retiring partner's loan account. Here we have discussed the important concepts relating to retiring partners' capital and event in partnership. Hope it is very clear to you. Thanks for watching this video. Stay tuned with Ekeeda. Subscribe to our channel Ekeeda. Thank you.